Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Today is Wednesday. It's a hump day. It's April 7th, and it's the second week of the second trading week of April. Markets are very calm today. I'm looking at the news. We've got the international trades in goods and services, which will give us a good information of how much demand and supply we have on the trades via supply and demand via international markets, which is really, really important, especially in light of the COVID vaccines around the world. It'll give us an indication of how things are bouncing back. From what I understand and from reading the reports yesterday, consumer spending in Japan is just terrible, and other parts of Asia as well. So that's going to be very interesting. But China is very strong, and that's where we get the bulk of the goodies from. So it'll be very, very interesting to see that. And it'll be very interesting to see Friday's PPI final demand. So by the end of this week, we'll have a good idea of how international trade is doing and whether there's an inflationary pressure on the producer's price index, which will be very interesting. And then tomorrow we got the jobless claims, and we're hoping the number is below 700,000. Please, 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 God, below 700,000. All right, those are the big reports. Now, as far as the broad market, it's doing nothing. I mean, we're just like flat. And the bond market, it's flat. I mean, down 0.18. This is like the definition of randomness, all right? Just nothing going on. So let's talk about the news, and then I'll give you some sentiment levels, and then I'll talk about how to take advantage, the best way to take advantage of this market. Remember, the market's always giving you cards, but you have to figure out how to play them. You have to play your cards based on what the market gives you. And there's always good hands and bad hands. And that's really what I'm trying to show you in these videos, how to always set yourself up for the best hands, for the low-hanging fruits. One of the biggest mistakes a lot of traders make is they overthink. They think if this happens, then this will happen, then that'll happen, then that'll happen, and that's how they invest. Don't do that. Invest in what's there right now. Don't look ahead, because every time you deviate or you think ahead a few steps, there's less probabilities of that happening. That's why Warren Buffett's motto in life is less moving parts. The less moving parts you have, the better the odds of something happening. Remember that. Now, Asian markets were mixed on Wednesday. President Joe Biden is bumping up his deadline. He's betting for states by 2 weeks to April 19th to make all adults in the U.S. eligible for COVID vaccines, reflecting steady progress in the U.S. Absolutely. Here in Florida, everyone I talk to is mostly already getting their appointments, already had their shots, and so forth. But it's been really good here in Florida. There was a really nasty 60 Minutes piece about Florida and how the governor here is whatever, but I'm going to be honest with you. It's been really great for everybody. Everyone I talk to, rich, poor, in between, it doesn't matter. People have been getting their shots or have had the opportunity to have their shots here in Florida, and I'm only talking about Florida. Now, the International Monetary Fund said it expects global economy growth to accelerate this year. I don't know about Japan, as vaccine distribution ramps up and the world rebounds. The 190-country lending agency said it expects the world economy to expand by 6% in 2021, up from 5.5% that it had forecast only a few months back. That would be the fastest expansion dating back to 1980. And that's why the markets are near all-time highs. Recent market gyrations mostly reflect varying assessments of the health and speed of the recovery from the pandemic. I don't think I could have put it in better words. Vaccine distribution is speeding up the reopening of businesses, while government stimulus is helping shore them up in the interim, at least in America. Now, I've already showed you the markets are flat, the bond market is flat, and there hasn't been much of a correlation between the bond market and the NASDAQ the last few days. And what I'm thinking is that the bond market is going to enter a choppy period right now. This is what we've seen in the long bond, and I think this type of market action, maybe go a little higher before it comes down, is going to persist. And the reason for that is because we saw such a strong downside move, and typically after a strong vertical move, you have a strong horizontal move. After a strong horizontal move, you have a strong vertical move. Notice I'm not getting directional. I don't know if that vertical move is going to be up or down, but the general rule is vertical, horizontal, vertical, horizontal. Those are the two waves. I know there's a lot of people out there talking about the Gann and Elliott wave. It's a bunch of nonsense, a bunch of phooey. I'm telling you, it really is. It's a bunch of nonsense. But it looks like the bond market's ready to go up, at least in the interim, just a bit, or at least give us a breather, which means mostly random trading action on the bond market without a lot of follow through. And that's really what I'm expecting over the next couple of weeks, maybe a couple of months. So not a lot of action on the bond market because we had a big move. And I think we are going to have another big move before the end of the year, but not quite yet. Now, here is something I need you to pay attention to. This is the put to call ratio. Let me expand the time period a little bit. Let's go to 6 months. Now, right now, as you can see here, put to call ratio is at 0.67. Pay attention. This is important. Now, whenever put to call ratio gets below 0.70, that means the number of calls being opened is really strong compared to the number of puts being opened. That's why it's called put to call ratio. Whenever you see the number above 1, that means a lot of puts are being opened. So when the number goes low, I'll summarize it for you. When the number goes down, when this line goes down, that means the market's getting too bullish, way too bullish for its own good. And when the market's getting up here to 1, that means the market's getting bearish. Right now, as you can see here, we're near the lower end of the range, which means the market's getting really bullish. Now, in light of that, I wanted to show you something that coincides with that tremendously. First of all, you will see that if you look at the, sorry about that. If you, drawing tool, I'm no artist, a trend line. See that? See how price is moving higher? RSI is overbought. That's not a good sign. First of all, the fact that RSI is overbought. Second of all, if you look at this trend line, you will see that we're having divergence again between price and the oscillator. So not only are we overbought, not only does it look like we peaked out and we're going back to the 50-day moving average, but we're also continuously seeing this divergence. Now, I've been talking about this divergence for quite some time, but if you look at the number of stocks trading above the 50-day moving average, this is a 5-year chart. Look at where we're at right now. That's 88%. We're stretched out, and we've been stretched out. And if you go to the 200-day moving average, you will see that 95% of stocks are trading above the 200-day moving average, which is right now, as I said yesterday, the highest level we've seen in over 15 or 16 years, 14, 15 years. And I would venture to say if this went back further, it would be the highest level we've seen in 20 years. And notice we've been around this range. We went a little lower, and then we went a little higher, but we're still at this range. We never broke down below this blue line, which is the 50-day moving average. So the point I'm making is this is showing us a stretched out market. And it never had a chance to really unstretch itself because we never really pulled back below the 50-day moving average. We need to pull back to the twilight zone. We need to go here. We need the number of stocks in the S&P 500 to go trading above the 200-day moving average to go to below 50th percentile. We need to go to make it go to about 40th or 20th percentile. Then this overbought market action and this divergence will go away. But till we see that, it's going to be very quick rubber band. Imagine you're trading. Imagine you're working with a rubber band. Do I have a rubber band here? I have some rubber bands here. Let me give you a real example. Imagine you have a rubber band and it stretches out and then it pulls back and then it stretches out again and then it pulls back and it stretches. It never has a chance to really pull back all the way. That's the environment we're in right now. I can't explain it any other way. You have a stretched out market, and then it pulls back like this, and then it stretches out again. Comes back in, stretches out again. Until it really comes back in, and that's the put to call ratio, and that's the number of stocks trading above the 200-day moving average, we're never going to get the market to trade normally. It'll always be in this overstretched environment. It'll always be like this. We need it to cool off and do this. This is how the market normally works. I know it's silly. A grown man is moving rubber bands around in a morning video, but seriously, the market needs elasticity, and it's not getting it right now, and it's doing this. And when it's doing this, it can't really move, really move. So it's going to be very stagnant and very fragmented. And again, this needs to cool off and come back right here so that momentum levels can cool off and this divergence finally goes away, because it's been persisting since September. So we've had it now for 6 months, and it's impacting the trading action on the S&P, and it's causing market to not rotate normally, and that's a problem. So I do believe the market needs a minor correction, nothing huge, but put to call ratios way overstretched out. The number of stocks, momentum levels is stretched out, and we're seeing divergence, and that's telling me we're going to have a little cool off period. Now, how do you take advantage of that? Look at StockFetcher. What's the weakest sector right now? Healthcare. Look at this. Average percentile. 3% last month, 5%, 10%. It's lagging behind. Consumer staples, but then healthcare. Healthcare is biotech, medical stocks, and look at the biotech sector. What do I always say? Low-hanging fruits. If the market is overstretched, if the put-to-call ratio is way overdone, then what you want to do is go for the low-hanging fruits. So if the market is due to bounce lower, if the market is stretched out, if the S&P is overbought and it's going to cool off, you want to go for the low-hanging fruit. And the low-hanging fruit is the healthcare sector. And you can look at the biotech. It's breaking down. It never went back up. Biotech, healthcare, that's where the money is to the short side. And what did I do? I put together 3 stocks and a ETF for you to trade, take advantage of this. Low-hanging fruit. If the market is set to go lower, why fight it? Why not just go with the weakest stocks or the weakest sector in the stock market, which is the healthcare sector? So XBI, biotech, is breaking down. It's in the twilight zone. It's where the S&P will be in about a month or so if this momentum level continues. I'm expecting this to test the 200-day moving average, especially with the S&P expecting to come down a little bit. So you could trade XBI. This is an ETF. It's tradable. But there's a couple of stocks that may look even weaker. Rocket Pharmaceuticals. Notice, same thing, right sitting at near the 200-day moving average. Did not ride this rally that we saw in the S&P. This upside momentum. The S&P went up. This thing went down here. So it's opposite. Looks like it's going to go lower. It's going to weaker, especially if the S&P starts cooling off. The weakest stocks will lose market cap first. So Rocket Pharmaceuticals is expected to go down. Ticker symbol RCKT. Next one, Arrowhead Pharmaceuticals. Notice they're doing exactly the same thing. Look at the chart here. Right between the 50 and the 200-day line, coming off of a 3-day pullback, coming back down. Right here, coming back of a bouncing pullback, coming back down. Going to hit the 200-day moving average again. Low-hanging fruits. Arrowhead Pharmaceuticals. Reminds me of Arrowhead Mountains in California. Arrowhead Pharmaceuticals. ARWR, RCKT. And last one, Deciphera Pharmaceuticals. So that's 3 pharmaceuticals. And look at that. This one's already crossed the 50-day. This is already way below the 200-day moving average. Look at the one here. This is just waiting. It bounced down to 40, and it's now 44, and it's going to bounce down again, in my opinion. So this is definitely on its way down. All of these stocks, as you can see here, are on their way down. So you got RCKT, you got ARWR, and you have DCPH, and the entire ETF, if you want to do it all in one shot, is S&P Biotech XBI. Now, notice what I did. I looked at the market. I looked at the most vulnerable spot. I looked at it internally. I looked at divergence. I looked at the RSI level. I looked at it internally. I looked at the put-to-call ratio, and everything is pointing to a cool-off, a slight cool-off. Nothing crazy, nothing big. What do you want to do when the markets cool off? You want to attack the weakest sector. Don't go for the strongest sector. Go with the weakest sector. If the market cools off, the weakest sector goes even lower. It can't keep up with the relative strength anyway. That's how real traders think. And the weakest sector is biotech, and I gave you the ETF that tracks it, which confirms that we're coming down, and then I gave you 3 stocks that are in that sector to trade or buy puts on: RCKT, ARWR, or DCPH. And that's what I call a complete market analysis. Now, Before I let you go, I've got something big, important, crucial, and timely. Folks, there's a brand new market loophole most people have never ever heard of. It's giving everyday traders the opportunity to grab payouts on thousands of stocks every single week. Man, opportunity, grab payouts, thousands of stocks every single week? Where do I sign up? In fact, Wall Street legend Chuck Hughes, he's already used this formula to signal winner after winner after winner with a 96.3% win rate. Man, I love that. Grab payouts weekly, 96.3% win rate. Where do I sign up? And that's even when he was wrong about the direction of the market. 96.3% win rate, regardless of the market's going up, down, or sideways. Man, I love this. This could literally be the best trading strategy anyone will ever encounter in their lifetime. And how often do I say that? And remember, Chuck is a 10-time heavyweight trading champion. 96.3% win rate? You don't want to miss it. Click on the link below. Access it now. Don't miss it. Grab weekly payouts, regardless if the market goes up, down, or sideways. 96.3% win rate. This literally could be the best trading strategy that you will ever encounter. Click on the link below. Get access now. And make sure to like this video, subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when we post the next video. Where else are you going to learn about how to trade rotations like this? This is real good heavy-duty training. I'll talk to you guys soon. Post some feedback for me. Bye, guys.